Okay. Okay, it's 5 o'clock sharp. I think it's time to get started. So I'm John Schwinghammer, the author of Purple Chips, and welcome to our Q2 webinar on April 18th, 2013. This is the first time we do this format, so please bear with us as we experiment here. First thing that I'm going to talk about is our disclaimer. As you know, there's no guarantees with this, but we're going to do our best. Now, about Purple Chips, a couple of things. You can look at the screen here and you will see that we do offer managed portfolios, which is a value-driven philosophy, as we talk about in the book. If you haven't read the book, you should read it. It's published by John Wiley & Sons, and it's doing very well. We use 3 criteria when we talk about Purple Chips: stable and predictable earnings, 7 years of rising profitability, the market cap of over $1 billion, and there's good reasons for this. It's a value-focused strategy, okay, very high-quality, low-risk blue-chip stocks that are at attractive valuations. It's very important to recognize that. You can follow us on purplechips.com, and you've got the Twitter feeds there. So we've got our members-only VIP feed, which gives you the real-time alerts on Twitter, so Purple Chips VIP, and of course all of our other commentary is on Purple Chipman. We've got some new features on our website. We have a watch list. We've got the company pages, enhanced search, etc. And we're going to look at the website a little bit later on. Now let's talk about the real reason that you're here today. Let's talk about Purple Chips and why Purple Chips is something to consider when you buy stocks. Purple Chips are top performing stocks. Okay, they're the highest quality stocks as seen by their earnings quality. And if you look at the top 25 U.S. Purple Chip stocks, we're actually up 29%. If you took them from the high that happened back in October of 2008, actually it was October 2007, sorry, there's a little typo there on the slide. We're actually up 29% versus the S&P, which is actually only up 1%. And I think as of today, that S&P number is only 0%. So we're actually up about 30% versus 0% on the S&P. On the TSX, the Purple Chip stocks, the top 10 Purple Chip stocks are up 61% versus the TSX, which is down 16%. And this was at, let's see, that was as of March 26th. So this is actually data that's a few weeks old. Now, let's talk about some of the closed transactions, because this is really an update more than anything. I don't want to go through all the basics of Purple Chips, but I do want to talk about, I want to get into more of the specifics on how we choose our stocks, why we close them out, why we take profits, and why we buy them when we think they're attractive. So I want you to understand the logic behind Purple Chips. I thought maybe we could talk about a few of the top stocks here. And Cisco, for example, we closed this one. We made about 29%. That includes the dividends. And we sold that very recently, just actually yesterday. We sold Cisco. We took the profit on Stryker also, SYK. We sold Towers Watson recently. We made about 24.7% if you count the dividends too, and Infosys. So I'm going to flip over to the actual Thomson One charts at this point, and I'm going to show you the reasoning of why we moved out of some of these stocks. So let's move over here, and now you're going to see what you have here is the stock for Cisco, and I'm going to show you exactly the kind of thing that goes into our decision making. So you can see that when you look at this chart, you've got a 20-year chart of Cisco, and the white line that you see here is the earnings per share line over time. And the important thing here, I'm going to grab this line here. I'm going to move it down a little bit. And you can actually see that the earnings per share line, okay, more or less mirrors the shape of the trading pattern in the stock, okay? So when I move that earnings per share line up there, you can see that there's some resistance in the Cisco stock around $22. And the support, okay, and this is based on the earnings pattern, would be around $18. So we actually think that if the market continues to sell off, that Cisco could potentially get back to about $18. So we were quite happy to take the profit. And the other thing that I'll point out is that when we actually bought Cisco, and I'm just going to grab my little pen here, when we bought Cisco, we bought it when it was right there. So the earnings line was on the bottom, and you could see that that coincided with other bottoms. So that was kind of our indication that there was a low valuation happening. And what we expected initially was that if you kind of drew a parallel line here, was that Cisco was going to get up around there. Now that didn't happen, and Cisco ended up doing this sort of thing. So it was sort of parallel to the earnings line. And it gave us some indications that Cisco was perhaps at a high valuation when we were around the 22 mark. Now, let's, I'm going to move this chart out of the way here. And some of the other stocks we talked about are Stryker and Towers Watson. So I'm just going to go over to Stryker and show you why we took the profit on Stryker. I'm going to, hold on, I'm going to erase the drawings here. Okay. So what we can see here is that in the case of Stryker, we had a very steady and very nice progression in the earnings. The white line is the earnings line over time. And you can see how this is the kind of quality stock that we really enjoy. With Purple Chips, okay, when the stock was at a low point, back around here, okay, we bought the stock. It was in the low 50s, and this was in anticipation that the valuation was fairly low, and we figured that the stock could reasonably get somewhere. We expected it to do this sort of thing, and we actually thought it would hit $70. It didn't quite do that, and so given the state of the market, we were quite happy to take our profit in this zone here. So we ended up taking the profit at just slightly below our target, but I think that was a pretty reasonable thing to do given that the downside on this stock, if it has a correction, which I think is more than likely, then you'll see Stryker probably get back somewhere in the mid-50s. So that tells you a little bit about the way that we see things. I'm just going to erase those drawings. Now let's look at Infosys, because that's a very interesting one, because that's one that we closed out recently. And I'm going to show you why we took the profit. We bought this thing around $42. We bought Infosys, which is a big Indian software company, a very good quality company, as you can see by the earnings. And what we did, hold on one second, there you go. Okay, what we did was we identified that the stock was pretty cheap around here. And we expected the stock to come up, okay, and to do something like that to get to the 60s, but that didn't happen, okay, and the stock was around very shortly after we bought it. The stock moved up into the 50s, and we ended up taking the profit right around here. I think it was around $52, $53, something like that. And the stock stayed up there, but the reason that we took the profit was because we saw a decline in earnings. So you actually saw the earnings come off, okay, and that was what spooked me out of the stock. And you'll see that in the case, when you have earnings that come off, like we saw over here, okay, the earnings started to go down, so the earnings were coming off. That was a sign to me, a sign of weakness. And then what happened was there was a second quarter where we had the earnings decline, and of course that's what precipitated the big drop in the stock. So we were quite fortunate, even I would say a borderline lucky on this one. We bought it around 42. We sold it at 52 in the space of probably less than a month. And then afterwards, the stock had another negative quarter, and the stock came right back down. And of course, now it's trading around support. Now, the rule with Purple Chips is that if the earnings start declining, as they are doing, then we're no longer interested in buying this. It's still a purple chip, but we don't want to be buying the stock until we see some positive progression in the earnings. So we're going to wait for that. And let's move on to some of the other stocks that we have here. I'm just going to move this Thompson 1 out of the way and go back to my screen here. And let's go to the next page here. Okay, these are the closed transactions. The page that I had just before, I'll just jump back to it. These were since 2013. So you can see we did pretty well. Sorry, I'm going to erase these drawings here. Just a minute. I'll get those drawings. Excuse me. Whoops. There you go. Okay. Hold on one second. Yeah, okay. And the other thing, I just got a cue to talk about position size. And position size is important, okay? You'll see the column on the far right, we talk about position size, and it's very simple. We have a rule that if a stock pays a dividend, it's a value stock. These are stocks where you want to have a full position on. A typical position for us is about 5%. So if you have, let's say, $200,000 portfolio where you have 30% of your money in fixed income and 70% in fixed income, then, 70% in equities, then we would look at your equity position and you would take 5% of your equity position. So in this case, if you have 70% of 200,000, okay, 5% of that 140,000 would mean that you've got about a $7,000 average 5% position size. So a full position that we talk about is really a 5% position. A half position, it would be a stock that does not pay a dividend. So in other words, a growth stock. So half positions typically are about 2.5% of your equity portfolio. So your equity exposure would be about 2.5%. So that gives you a little bit of an indication of how we work here. With the purple chips, we always favor the dividend-paying stocks, the real value stocks. And the other thing, too, is that with a growth stock, if you have a half position, this is a way of controlling your risk, too. So it's important to follow these rules because, as you've probably seen lately, many growth stocks, when they disappoint, they really do get impacted quite severely. So let's move on to the closed transactions. Okay, so before the other screen was 2013. These are all of the stocks that we've been tracking since the last year and a half. So you see many positions where we closed them back in December of, for example, 2012. The top of the list, Home Capital. We had made 38% on this when you count dividends. And that was a full position, so that was kind of fun. That was a really nice trade. And this is very typical of a lot of the purple chips investments that we do. You know, we often are able to capture anywhere from 15 to 30%. So getting more than 30% is a little bit unusual. So that was quite nice. So you can see that the list is quite impressive. You've got the position size there. Now let's move on to the current positions. And over here, I want to talk about a little bit of everything. I want to talk about some of the stocks that aren't working out so well. And you're probably wondering, you know, why do we still own Apple if it's down 24%? Well, I'm going to make a case for you that shows why we're going to continue to stay in Apple until we have proof that something's really going wrong. So it is possible that we'll be wrong with Apple, but let's have a look at it right now. So here we have the chart, and these are live charts, okay, for Apple, and I can see that Apple is currently trading around 391.5, and this is in the aftermarket. And so what you've got here, you can see the earnings per share line, the white line here, over 20 years, and you can see a very nice progression, and particularly since 2009, super huge growth in the earnings. The stock price had gone way up to about $700, and recall that that's when all the analysts were getting very excited about it. And now the stock has retreated to $400. We started picking up Apple around the 540 mark based on the earnings that we had, 530, 540, something like that. And we still own the stock, and the stock's currently trading around $400. So you have to ask yourself, okay, why is he still owning Apple if the stock's been going down? The reason is simple. We don't see any reason to tell us that this stock should be worth less than that. We may not get $550 or $560, but we don't think we're going to lose money on it. Okay, the stock is still undervalued. It's trading at 9 times earnings. This is a company that's growing much faster than that, and it also has $139 billion of cash on the books. This is a company that's had a stellar performance, and even though the growth is flattening out, the potential is still there. So we think this stock is still undervalued. So we're going to stick with it until we see a reason to get out of it. So if the earnings were to come off, then, you know, then we would consider changing our position on Apple. But at the time, for the time being, there's no reason to change our view of Apple, let's say. Now, let's talk about some of the other stocks here. I'm going to go to F5 Networks. Okay, that's another one of the stocks that's not doing so well for us. Just a minute. Okay, now you can see with F5 that we're at a very low valuation, and this valuation actually coincides with what we saw back in 2009. I'm going to grab my pen here. I'm just pointing out the low valuation that we had in 2009 and the current valuation. So you can see that the earnings per share line is nice and smooth here. It's the kind of thing that we like. And based on the way we look at Purple Chips, we think that this is still a pretty good quality stock. There hasn't been any reason to think that the stock should fall out of bed any further. So there should be pretty good support here because we are at the, similar valuations to what we saw in the weak point in 2009. So this is a good quality stock. Does not pay a dividend, so recall that this is a case where we would only have a half position. Okay, so that's important too. Hold on one second. I'm just getting a note from my colleague. Okay, the movement of the EPS line. I'm getting a question from Mr. Joe Schaub. He wants me to explain how I move the EPS line. Joe, I can do this on my screen with the Thompson 1, but unfortunately you can't. The way this works, I'll just show you. You see, I can move this thing around, okay? And what I'm doing here is I'm moving that EPS line up and down. The way the EPS line is programmed, it's actually programmed so that it matches with the last trade on the stock. And that's an important indicator of valuation. So when you have the EPS line down here, you can see how it corresponds with other lows in the stock like back in 2009. So that's telling you that that's a low valuation. If the stock was much higher, let's say the stock was trading at 105, what you'd see, you wouldn't see exactly what I'm showing you here. You'd see the EPS line being kind of in the middle of the range of the stock, but it would be slicing through some of those parts back in 2007 also. It would have a slightly different slope, a slightly steeper slope. But this is an indication that we were not at the lowest valuations when we were at 105. Now currently, at the price of $72, we are actually at the low valuation. So let's go back to our screen here, and we're going to move on. Actually, there's one more stock I'm going to talk about, which is Baidu, and I'm going to show you just a minute. I'm going to show you Baidu. And the reason I want to show Baidu is because Baidu has such an interesting earnings per share line, and so we still have no indication that this stock is turning down. So it's a very interesting company. The PE multiple is only 18 times, but this stock is growing well over 40%. And of course, Baidu is the kind of the Google equivalent in China. So it's an interesting company. But this is, again, a half position, too, because this is a growth stock with no dividend. Now, so at this point, hold on one second, please. Okay. We're going to go back to a few of the more current positions. Okay, so here, let's see. Let's talk about some of the stocks. Okay, so how about the banks that we just initiated? Okay, we talked about Canadian Western Bank. So I'm going to bring up Canadian Western Bank and TD. There's a couple of stocks that we'll look at right now, because these are very recent buys that we did, and we still think these are valid stocks to own. So here you've got an example of TD Bank on the TSX, and currently the stock is trading around $80, and you can see the positioning of the earnings per share line. And it's not an accident that it coincides with many of the bottoms in the stock chart here. So this is telling you that there were low valuations back then. And just a minute. I'm going to grab my pen here. So you can see low valuations, low valuations, low valuations, low valuations. Now that's based on the positioning of the earnings per share line. Low valuation here. Okay, so recently, since 2009, the earnings have been going nice and high there, and so you can tell that this was a low valuation. And I'm just going to go back to the other mode. I'm going to erase that drawing. Now, if I grab this earnings per share line and move it up, it's going to give me an indication of where I think TD Bank could go. And the reason I'm saying this is because this is actually consistent with other high valuations that we saw in this stock. So I'm going to grab my pen, and I'm just pointing out a few of the higher valuations. And what I'm doing is I'm kind of taking an average of the high valuations. So you can see that if you look at this chart, okay, the white earnings per share line was pretty high relative to the stock price, which was telling us that the valuation was fairly high. So TD Bank could go to about $90. It's not impossible for it to get there. It may only get somewhere up here in the 85, 86 zone, but we think owning the stock around 81, 82 is pretty safe, and it also pays a good dividend. Consider, there, note at the bottom of the screen here, you can see the yield, 4.05%. So this is the kind of stock that's very interesting. We like that kind of stock. I'm just going to erase the drawings. Just a minute. Oh, yeah. Yeah, we're going to talk about some of the other stocks that we would still be getting into. And so I'm going to look at National Bank. These are some of the recent picks that we had. And again, you see the kind of profile that we like. And so the earnings per share line is below the average stock price, and consequently, valuation is fairly low. And what I expect with National Bank is that we're going to see, assuming that the earnings continue, at the very worst case, we're going to end up back at $80, and probably in a more optimistic case, maybe 82, 83. So we're not looking for fortunes on these stocks, but we do think that they're quite undervalued over here. Now, recall that we bought the National Bank at $75.50, and we did collect a dividend already, because about 2 days after we bought it, the stock went ex-dividend, so we already collected an 83-cent dividend. The stock pays about 4.5%. It's actually a $3.32 dividend annual, and you can see that right down here. So the stock pays a $3.32 dividend, and the dividends are paid every quarter. So we already received, I believe it was about 82 cents. The stock is yielding 4.5%. Now, let's just see here, just a minute. Okay, let's talk about Canadian Western Bank. You can see that they're cleaning the office in the background there, because it's after hours. Canadian Western Bank. This is an interesting company. Again, it's a bank, not one of the big banks, but an interesting bank that operates mostly in Western Canada, and something that we bought recently. Pays a dividend of about 2.4%, annual dividend of 68 cents a share. And currently, we are at an interesting valuation. I'll grab my pen here, and you can see, I mean, we're in the zone here that is considered low valuation. High valuation would be somewhere around here, which would be consistent with the other tops. See, if I drew a parallel line, then you start to understand what happens with the earnings per share. So I'm just drawing the line here. I'm doing this freehand, so you'll have to bear with my artistic incompetence. But that sort of gives you an idea. If the stock, if Canadian Western Bank was at $32, you can see how the earnings line would look. That red line that I drew there resembles what it would look like. And that gives you an idea of the trading range that you can expect on a stock. So the earnings per share line is a great indicator of how valuation happens, of the valuation range that you get in a stock, because it's no accident. A stock will trade, the stock price will actually mirror the shape of the earnings progression over time. So if you have earnings declining, then obviously the stock should decline. And I'm going to give you another example, okay? This sort of brings up an interesting point. I want to talk about why I mean, this is a purple chip stock, so you can see that there's a nice correlation between stock price and earnings. But you'll also see it in other companies that are not purple chips. Okay, and I'll give you the example I always love to pull up is AT&T. And hold on one second, I'm just going to erase this line. Okay, this is one of my favorite examples. Okay, this is AT&T, and a lot of people love AT&T. It's a real blue chip stock in the U.S., but it's not a purple chip. Okay, and the reason I don't say this is a purple chip is because it's clear when you look at the earnings. Okay, you can see that the earnings go down, and they go up, and they go down, and guess what? Today, AT&T is earning $2.33 a share, and guess what they were earning right here? It was also $2.33 a share. So what happened to the stock? The stock was trading around $38 then. Stock is trading 13 years later, still at $38. So why would you want to invest in a company that has not made any progress in its earnings? So that's my picture of why purple chips are way superior to other companies. So I hope everybody understands that. Hold on one second. I'm getting messages from my back office here. So, okay, one thing, if you would like to ask us questions, if you want to send a question to me, I've been told that you should open the chat window and ask a question. Ask me about a stock. I'm going to show you a couple more stocks, and then we're going to take some questions. So let's talk about PetSmart, PETM. This is a nice stock, very interesting. And you can see when we bought this stock, it was a little bit lower. It was around the 62 range. Now it's currently around 66, and it's holding up. So we haven't had much of a correction in this stock, which is kind of fun. And again, this is actually a full position because it actually pays a dividend, which is nice. So it's got a small dividend of only 1%. But you can see the reason I like this stock is the earnings progression. This is the kind of stock where when we bought it, it was around 62 here. You can see this. So we bought it around here. We're currently trading right here. And what I'm expecting is that this stock, assuming the earnings continue, okay, and people love their pets, so they're spending all kinds of money on pet food and pet this and pet that and pet hotels, and that's a very popular theme to forget about the kids, let's take care of the pets. They're much more interesting, right? They don't cost as much. University for pets is cheap. So anyhow, so if the earnings continue on PetMart, which I think they will, then you could potentially see a stock that is worth easily in the $74, $75 range, assuming that the earnings continue on the current path. And just getting over to looking at the multiple, this stock is trading at 18.5 times earnings. Now, we looked at the growth of this company, and that was actually reasonable considering their growth rate, and you can sort of see that in the earnings too. The earnings are growing very, very quickly. So if the next quarter, if you get the similar bump up in earnings, it would not be surprising to see the stock trading $68 to $70 in very short order. And the other thing that I like when I look at a stock like this is this pane on the bottom here shows the progression in dividends. And so you can see that the dividends have been going up since 2008. We've been rising like this.
Well, he's nervous with you probably.
I know he is, because I'm nervous with him.
Okay.
Are you
I tell me where anything was on it.
Right?
Where it could break, and he didn't know.
Okay, now let's...
I don't go fast enough. I don't even use the brake myself, honey.
Someone's going to have to mute their phone there. I can hear some background chatter.
I wanted him.
I know, but I don't use the brake. Like, just if you go slow enough,
Okay,
you don't
now
need,
let's talk about Aflac.
I never use the brake.
Hold on one second.
Just keep it in first gear and go slow. It won't go fast.
Okay, we're getting some background chatter there. Sorry, people. Not sure what happened there. Okay, let's talk about Aflac. This is a company that we still own and we like a lot. Aflac pays a dividend of $1.40 a share. It's currently yielding about 2.8%. The thing I like about Aflac, this is a classic purple chip stock, okay? one of the top 25 stocks, and the reason being is that even during the credit crisis, this stock never missed a beat. So you had this, you had the Japanese earthquake, okay, and Aflac does a lot of business in Japan, and the earnings never missed a beat. They continue moving higher. This is the kind of stock that is very, very impressive. We think that Aflac eventually is going to make its way probably up here. And the reason that I didn't when it was up in the mid-50s is because this stock is so undervalued. If I look at the, hold on a second, I'm just going to erase the drawings, and I'm going to show you something. Okay, the earnings per share, they're currently running around 660. The PE multiple is 7.4 times earnings. And this stock should be trading at least 10 times earnings. So we think that it wouldn't be unreasonable for Aflac to get somewhere in the low 60s. So this is one of the examples where I don't feel we may never see another opportunity to buy the stock at $42 again. And so I don't think it's worth taking the profit on it at this point. Even though we have a fairly good profit, this is the kind of stock that you just want to hold on to. It pays a decent dividend, and it could go considerably higher. Now, let's talk about Global Payments. Okay, and the purpose of this meeting is to show you how we come up with our ideas in purple chips and why we take profits and why we buy stocks. Okay, in the case of Global Payments, you can see this has a fantastic earnings progression. It pays a small dividend, but this is in a great business. They're in the credit card processing business. And as you know, companies like MasterCard, Visa, etc. are doing very well because the demand for, well, how would you say, the cashless society that's developing is going to be using a lot of things like MasterCard, Visa, and the back office processors like Global Payments. So Global Payments is in the sweet spot, and I think this is a company that, as you can see, the earnings are still rising, and I think that eventually you're going to see this stock do this sort of thing. So Global Payments will probably, in my estimation, get up somewhere in the mid to high 50s, and I don't think it's going to take too long. So that's pretty much the recap on some of the stocks that we've done. I'd like to invite people to give me their questions now, and we'll see what we can do to answer them. Okay, hold on one second, please. My colleague is collecting the information. Okay. Joe is asking, do you consider the market when closing positions? Do I consider corrections? Joe, that's a good question. What I do is I'm trying not to time the market so much as trying to keep some cash available when there aren't many opportunities. We had signs that the market was fairly high. Now, I can never, ever predict when there's going to be a top in the market or a bottom. Okay, all I can do is apply the same consistent methodology all the time. We currently, our position, okay, we think that the market is in a bit of a correction mode. I don't know how far it's going to go. That would be impossible to say. But I want to make sure that I have enough cash because I know I've been through this many, many times, okay, and I've been doing this business for almost 29 years now. And when the tide recedes, the boats go with them. Okay, so the tide recedes and the boats actually go down with that tide. So what I'm doing is I'm looking through our list of companies, and there are some cases where I will take the profit because I estimate that those companies can retreat a little bit with the tide that's moving out. If I was very optimistic, if we still had a market that looked like it could go considerably higher, where we still had a number of buy signals and we had loaded up on many companies, we would be waiting. So I'm trying not to time the market, okay, because I think that's a dangerous thing to do. I'm trying to have the cash available when there's opportunities that are presenting themselves. So we knew that there'd be a little bit of a pullback. And so we did take some profits on some stocks. I'm still holding a lot of good stocks, okay? I'm not selling Aflac. I'm not selling Oracle. I'm not selling Shaw Communications or Family Dollar just yet. These are companies I could have pulled the plug on, but I don't want to start giving you the impression that we're going to trade every twitch in the market. That's not what Purple Chips is about. We're identifying fantastic companies. We get in at low valuations. We stick with them until we see that they're at a reasonable to high valuation, in which case we'll get out, or we even take a profit when there's an opportunity to upgrade to a better quality position. So that's the kind of logic that we're looking for. Now, does anyone else have any questions that they would like to ask me at this point? So we're about 35 minutes into our webinar, and okay, now I'm going to show you some of the information on the website in just a minute. Let's go over here. Okay, we've made a number of changes on the website, and this is probably a good time to review this. Okay, you can see on the right-hand side of the website page, okay, I'm on the website page right now, and you can see that this is the dashboard. There's a lot of information on the dashboard, and you should consult the site fairly often. We have the VIP tweets on the right-hand side. These are live, okay, so every time that I'm talking about changing a valuation range, or if there's an action alert going out, you should look at these, because this is where you're getting the up-to-the-minute information on Purple Chips. And if we scroll down here, let's see, that's the Twitter side. Wait a second, I'll just grab this bar here. Okay, and you can see there's a lot of information on the dashboard. I'm going to go a little further down. Okay, and I want to point out this window here. You can see the valuation count, and this is kind of interesting because it shows you the number of Purple Chip companies that were at a low valuation. Okay, so right now we're running around, it's about 11 companies, I believe, that are showing buy signals. And if I go down a little bit further, you're going to see, of course, the current low valuations. There's quite a few of them now. Because a few days ago we didn't have too many, and we've got a number that are within 5%. So you have a pretty good idea here of the stocks that are here. The ones with the stars, I'm going to grab my little pen here. These little stars here, okay, these are in the top Purple Chip stocks, okay, so the Aflac, Express Scripts, Teva, these are all top 25 stocks, C.H. Robinson, EMC, Bank of Nova Scotia, which is not a buy yet, but it's in our top 10, and FactSet, top 25 on the U.S. side. So these are pretty close. So this is a good screen to look at because you really get an idea. You can prepare, okay? I mean, you can see Global Payments. Global Payments, we were buyers at 43. Right now it's trading around 45. Okay, and hold on one second. I'm just going to erase this page now, and we'll move on. Okay. Okay, I'm going to click on this Infosys, and just to show you what happens here, just a minute. Whoops, I jumped out of a page there, just a moment. Okay, now, I just clicked on Infosys, and this is what happens when you do that from the dashboard. Okay, so you've got the valuation history, which tells you a little bit about where the valuation's been going for us, and so we had a little bit down, so the range in valuation was shifted down, then slightly up, and then down again. And that was based, of course, on the earnings. You've got some basic information on the stock, and then you also have, oh, and I'm having a little bit of an update problem with the chart here, so forget about that part. Okay, so let's go back. Yeah, I'm just going to go back to the dashboard here, just a minute. And you can see, Okay, so we're back at the low valuation, the page which shows us our dashboard. So there's a lot of information on here. So you've got the U.S. page, you've got all the stocks. You can click if you want to find out the TSX stocks. You can do that. Just click on that. Okay. And I'm going to go back to Google. Hold on one second, please. Okay. Okay, some earnings just came out for companies like Google, and I'm just going to show you. Okay, this is kind of interesting. Google, here, this is the chart of Google, and you can see that the earnings are very nice. Google just came out. They beat on their earnings. The stock is currently around 777, and we had closed at 765, so we should be about $10 higher. So it's going to be around there. Not a big change for us. Our range on Google right now, I believe we're going to be we would be selling somewhere around the 840 mark, and it's going to be very close to the same numbers. And if we were buying Google, we would probably, we'd be in the 650, 660 zone, something like that. So I don't have the exact numbers in front of me. I'd have to look on our website to find them. I can't remember all 300 by heart because I don't actually own Google right now. And actually, I'll point out another one that just came out after the close today was IBM. And this one's kind of interesting because IBM, this is really a stock that I love. I mean, you look at the earnings per share line on this, and it's incredible. And it's no accident that the stock's been going up beautifully because look at the earnings. Now, the earnings came out, they disappointed, and the stock is currently at 197. So IBM is down about $10 as we speak here. So that means at 197, we are going to be, the earnings line is going to be right there. And guess what? That is very close to where we would be buyers. Now, I'm not going to say we're going to buy it yet, okay? I know that our target on this one is at 195, but I'm going to look at the earnings. If we had an earnings miss where the earnings actually declined, then I'm going to lower my low valuation target. If the earnings came out and they were actually okay, so they continued their current trend, then the 195 is going to stick, and we might even raise that. So that's to be evaluated tomorrow, so we're going to see. So I guess that is pretty much it. That's pretty well a wrap, and I'd like to just hang around for a few more minutes and see if there's any more questions. So if anybody has any more questions, I would love to hear from you. And so I'm going to wait. Or if you have any questions and you don't want to, if you can't think of anything to ask me right now, or if you have an example you'd like me to look at, if there's a stock you'd like me to pull up a chart on, feel free to just open up that chat box and give us a symbol, and we'll have a look at it, and we'll give you our assessment of it. The other thing, too, is if you don't want to ask us a question right now, you can always send us an email at members@purplechips.com, and we'll be happy to answer you. And you can always pick up the phone and call me. That's another thing, too. So this is something I don't always have time for everybody, but I'm going to do my best to make sure that everyone gets served. Oh, we just got a request for GE. Now, GE is an interesting one because that's one where I think there's a possibility that this stock might come off a little bit. Now, it's kind of interesting. GE, like a lot of iconic American companies, is starting to come back. And you can see it in the quality of the earnings. This is what I'm talking about here. Okay, so the earnings are picking up, which is a good sign. And hold on, I'm just going to erase this. Okay, now, currently, GE, the position of the earnings line tells me that this is probably in the high end of the range, okay? It might get a little bit higher, but it's going to have trouble getting through that 23, 24 mark because the market's pulling back right now, and so I wouldn't be surprised if you saw GE go back to like 1920 if the correction continues, okay? Because the American stocks still have they got to show us the money. They got to prove they're out of the woods. And GE Capital did substantial damage to the company during the credit crisis. I mean, you can see that with the collapse in the earnings here. And this is why the stock repositioned down here. So that's my view on GE. So I think it is possible that GE could come off a little bit. I don't consider GE a very risky stock, though, to be frank. I mean, it pays a good dividend. It's 3.5%, 76 cents a year. So this is good quality, but GE hasn't made any progress with its earnings, for the last few years. I mean, it's been picking up, okay, which is good. But I mean, if you look at let's say the last 10 years or so, we still haven't done great. So it's not fantastic. The other stock that someone asked about was Express Scripts. Okay. It's a good thing that my buddy Mark is sitting near me and giving me the cues. Okay, Express Scripts, a very interesting company. Okay, and this is one of course, that I like because it's currently at our low valuation target. And it is no accident because I'm pointing out the low valuations here. And you can see that. And this has the kind of earnings line that we love. I mean, it's a top 25 for a reason. Look what happened during the credit crisis, okay? 2008, 2009, stock price goes up. Well, guess what? The earnings didn't go down. So this is what I like. And they keep on going up. Now, if the earnings continue, I'm just going to move this thing up here. Okay, what you could expect on Express Scripts, okay, all things being normal, this stock should get up somewhere around the probably the high 60s or so. It does not pay a dividend, okay, so remember that this is a half position the way we look at things. So it wouldn't be unreasonable for the stock to get up, above 66, maybe $68. And that's assuming that we maintain the current valuation range. Okay, and on the low end, the stock could get possibly as low as about $52, but I don't think it'll get much lower than that. So it's pretty interesting. Are there any other questions about stocks, things that you'd like me to review? Okay, I'm getting a lot of questions here. So Family Dollar, let's have a look at Family Dollar. This is one that I like a lot for obvious reasons. I like the dollar stores because they're very defensive. Okay, so even if the economy doesn't do that well, you can expect Family Dollar to do pretty well. These guys are good operators. I mean, since 2008, you can see the earnings are rising nicely. And what I would expect is that Family Dollar should get somewhere in the mid-60s. And you can see, okay, I've positioned the earnings line so that it kind of corresponds to the highs here. And I think $66, $67 is a reasonable target for this stock. And on the downside, there should be pretty good support around 56. Okay, based on the shape of the earnings line, we should be okay there. Now let's talk about Dollarama. Okay, for our Canadian friends, Dollarama is an interesting stock. Now it's not on the purple chips list because I don't have enough history on it. And you can see that the earnings per share have progressed beautifully. It will be on the purple chips list when I've got about 7 years of data. So unfortunately, you're going to have to wait a few years. So it's not going to be on that list anytime soon. If you ask me what's the stock worth, well, the high end of the valuation range would be about $70, I guess, based on what I see here. And there'd be a lot of support, okay, based on the shape of the earnings pattern. The low valuation range would be around $60. Is it a purple chip yet? No, because I don't have enough history, and I want to see these guys ride out a few cycles. Now, I'm confident that the Dollarama folks are going to do very well in any cycle. These guys are good operators, but keep in mind, okay, it's also a question of their growth rate. And Dollarama trades at 24 times earnings, so this is not a cheap stock by any means. Remember that a stock that has a high multiple should have a very high growth rate. And that's how you can justify a high multiple. If you don't have the growth rate to support that multiple, the stock can collapse. When a stock collapses, it's usually going to come right back to that market multiple, okay? And the market multiple in this case, for the TSX, it's around 14, 15 times. For the S&P, it's around 15, 16 times. So when a stock gets into trouble, it goes bang, right back to that market multiple. So Walmart and Shaw. Okay, somebody is asking me about Shaw, so let's take a look at Shaw first. Okay, this is the chart for Shaw. This is a pretty interesting one. We bought this stock when it was really out of favor, and it was kind of fun because I bought it in this period here when it was around $20, and I bought it because we had a low valuation signal in it because it made a ton of sense. You had this sort of situation where the earnings were rising, the stock was doing nothing, the valuation was reasonable, and guess what? The earnings continued, okay? And the stock started to go up. Now the stock's come off a little bit. We're at $23. I still think that this stock can go higher. Okay, I'm just going to erase my charts here. Just a minute. Hold on. Whoops. Okay, I'm erasing this. What I'm expecting with Shaw, I think it would be very reasonable to see the stock get a little bit higher in valuation, maybe up around $26. This stock pays a very good dividend. It's paying $1 a year or $102 a year, 4.4%. People love their dividends, so you know I would expect this to get up there. There's also been some talk of potential takeover. So this Shaw is being seen as a potential takeover stock with the consolidation of the whole TV, cable, communications area. So this stock still has some room to go. In my opinion, I think $23 is pretty cheap. What was the last one we wanted to see? Okay, Walmart. Whoops. We don't want to look at that. That's a Vancouver stock. Wrong symbol. Okay, Walmart. This is a store that I hate, but I love their stock. I absolutely detest shopping at Walmart, but I just love owning their stock, okay? And we've owned the stock before. What's interesting about Walmart is that they had a little bit of a correction, okay? They moved up, and we missed the boat, okay? We actually thought it would get just slightly lower. I think at the time, if I'm not mistaken, our low valuation was it around 66, 67 or so? Maybe 65, yeah. And I thought that we would get have a little bit more of a retracement. And of course, I only want to put low valuations that seem very low risk. And so sometimes I miss opportunities. And Walmart actually was a case where we missed it. The stock went straight up. And now it's trading, well, it's about 15 times earnings, which I guess is okay. I mean, they're probably growing around 10% a year. Walmart is interesting for another reason too, though, and the thing that I want to point out, we've owned Walmart in the past, by the way, because when it was actually down in the $50 zone, okay, we bought it there because it was just a screaming low valuation, and unfortunately, we sold it right about here. Okay, so we made some money on it, but not as much as we could have, and that happens sometimes. But we used the money for other opportunities too. So it wasn't so bad. The thing I wanted to point out with Walmart, though, is that it's kind of interesting. It's sort of a barometer of how the market's feeling. And I'm going to erase the drawings here. And you see how we had a low valuation there, then we moved up, and we started making higher valuations, okay? The stock moved up to about $76. We started going higher valuations. We come and do a bit of a retracement, and guess what? And we're moving up to high valuations again. This is telling me that the market, the underlying market sentiment is getting better. Okay, we're not doing consistently lower valuations. We're starting to break out of that pattern, and we're starting to move to higher valuations. The valuations are getting slightly higher for stocks like Walmart. So Walmart at one time was trading, maybe a year ago, was trading around 10, 11 times earnings. Now we're trading at 15 times earnings. That's a good sign. That's the kind of thing that you want. That's a sign that we're emerging from the bear market and valuations that we saw for a long time. Now, what else do we have here? Teva, and then one final question. Okay, Teva. Teva has been my curse lately. We've owned this stock for a long time. We had bought bought it around 42, and you can sort of see why we bought it. It's got a very nice earnings progression. It's still a solid stock, okay, and I haven't got any reasons to think that this earnings per share line, the trend has been broken. It has not yet, okay? However, if in the next quarter, if I see the earnings go like that, to me that's going to be a sign. So if we do a downward leg in earnings, that's going to be a sign that the earnings trend is broken, and I'm going to take the hit on Teva. So we own the stock around $42. I'm being a little bit cautious with it right now. I'm not pounding the table too much on it because I'm not sure if this is a value trap or not. I don't think it is, but I haven't got the indications yet to say that we should sell it. So I'm going to wait. I'm going to be patient. I'm going to follow the plan. And last question, somebody is asking, does historical dividend yield provide a floor on stock price? The answer is no. Okay, dividend yield has nothing to do with the floor on stock price because dividends attract people, but it's the earnings that matter. You can't pay dividends without having earnings. Okay, so the dividend yield is not a good gauge of where the floor on a stock should be. So that's the answer to that question. So look at earnings first, dividends second. If earnings are progressing upward, then you're going to see dividends progressing upward, actually like the chart that you're seeing right here. And I'll just draw that out here. You can see, okay, this is the dividend chart. It's showing dividends per share increasing over time, earnings per share increasing also. You can't have one without the other. So, well, actually, in some cases, you have, as an example, AT&T. They kept raising the dividends over the year, but the dividend payout ratio was low enough, so there was enough cash flow to do that, even though the earnings had been going down. Okay, so first look at earnings, second at dividends. So dividends are not what creates a floor in a stock price. And I think that is pretty much a wrap. And so I thank everyone for participating in our webinar, our first webinar for Purple Chips. But certainly not our last, and I look forward to meeting some of you sometime and to having you back at Purple Chips. And of course, I invite your questions. Feel free to send me an email anytime or give me a call. Pick up the phone. Don't be shy. I'm around, and you'll see us in the media very soon. Thank you very much. This is John Schwingheimer. I'm signing off for Purple Chips. Thank you. Yeah. Just a minute. There you go. Erase all drawings. Bada bing.